You're tuned in to your ultimate pit stop, Piston Pundit, where global economics downshift into real-world consequences for car lovers and curious minds alike. April 2025 hit the throttle on financial drama as President Donald Trump launched sweeping new tariffs. But instead of revving up American dominance, the move triggered a sharp skid across global markets. Foreign debt holders, most notably China and Japan, began reconsidering their massive U.S. Treasury positions, sparking panic and speculation. What followed was a financial slide with serious traction loss. Let's break down what happened, what it means, and where the road might lead next. Tariff shockwave and the fallout in financial lanes. April 2025 will go down as a month of major economic recalibration. President Trump threw down the gauntlet with an aggressive trade offensive, blanketing all imports with a 10% tariff and slapping Chinese EVs, tech parts, and steel with jaw-dropping 145% surcharges. The message? America first. No ifs, ands, or international exceptions. But instead of forcing rivals to yield, markets went into a tailspin. The MSCI All-Country World Index shed over $5 trillion in value within days. Wall Street stumbled. Most alarmingly, yields on U.S. Treasuries, normally the safe harbor during storms, soared. The 10-year note spiked to 4.592%, the highest since early 2024. That's not how this is supposed to work. Typically, when the economy gets dicey, investors cling to Treasuries. This time they ran. Why? Because investor faith was shaken, not just by the tariffs, but by the administration's volatile economic signals. The engine of trust was sputtering. Trump's policy whiplash, one moment stimulative, the next restrictive, rattled institutional confidence. And once hedge funds began facing margin calls, they started dumping Treasuries to stay afloat, compounding the chaos. Even the almighty dollar lost traction against the euro and yen. Gold dipped before recovering. Global markets were suddenly questioning whether the U.S. still had a firm grip on the financial steering wheel. As this confidence crisis deepened, the bond market, once rock solid, began showing signs of structural fatigue. U.S. bonds, once a fortress, now fragile. The most unnerving twist? The sell-off wasn't confined to a blip on the bond radar. It was a full-blown skid across all maturities. From 10-year notes to 30-year bonds, yields surged in unison. No war, no financial collapse, just one administration's misstep, enough to shake a system built on $33 trillion of U.S. debt. Of that, around $7.5 trillion is held by foreign powers. For decades, America's engine ran on borrowed fuel, powered by global lenders who believed in its long-term reliability. But with Trump's aggressive policies inflaming inflation fears and inviting instability, many of those backers started pumping the brakes. Europe and Japan reportedly rebalanced their portfolios toward homegrown bonds. Hedge funds, facing pressure, unwound leveraged plays and dumped treasuries. And then came the return of the long, silent bond vigilantes, investors who punish reckless governments by selling off debt en masse. The message couldn't be clearer. If Washington doesn't tune its fiscal engine, the bond market will do it for them. Even more troubling is the vicious loop this creates. Higher yields mean pricier borrowing for Uncle Sam. That inflates deficits, which then further spooks investors, pushing yields higher again. It's a self-feeding cycle that could see the U.S. paying more to finance its debt, unless confidence is quickly restored. Before we delve deeper, take a second to like and subscribe. It helps us bring more insights to fellow gearheads who love the story behind the steel. With that pit stop done, let's steer toward the next global heavyweight, China. China's calculated leverage, playing the long game. China, holding over $760 billion in U.S. Treasuries, is watching closely and maneuvering with precision. While it hasn't made any dramatic moves, whispers abound that Beijing may be gradually shifting funds toward euro-denominated assets or German bunds. Think of it as a warning shot, one that says, "We're not thrilled with this ride." But China knows the steering wheel cuts both ways. A sudden sell-off of U.S. debt would sink the value of its remaining holdings. It could also strengthen the yuan, making Chinese exports less competitive, a risk that's particularly dangerous when economic growth is already facing headwinds. So instead, China is likely to choose finesse over force, adjusting its holdings quietly, signaling its displeasure while avoiding financial whiplash. Still, even subtle shifts can have serious ripple effects. If China reduces its Treasury exposure meaningfully, the US could face steeper borrowing costs, and global markets might get another jolt. But China isn't the only country recalibrating its financial gears. Japan is navigating the same road with a very different approach. Japan's calculated calm, prioritizing stability over leverage. Japan, now the world's top foreign holder of US Treasuries, stacking over $1.08 trillion, chose not to follow China's more tactical footsteps. While Washington's fresh wave of tariffs landed squarely on Japanese exports, Tokyo made its position crystal clear. Treasury holdings aren't a bargaining chip. Finance Minister Katsunobu Kato reaffirmed that these US bonds serve primarily for exchange rate stabilization, not geopolitical retaliation. Japan's approach reflects a deeper strategy, less about theatrics, more about preserving investor confidence and long-term growth. That said, Japan isn't immune to the current economic headwinds. The US tariffs are a body blow to Japan's export-heavy engine. Combine that with global bond turbulence, and policymakers in Tokyo are keeping their fingers on the pulse, cautiously tracking how fast this ripple becomes a wave. But by maintaining a steady hand, Japan sends a broader message. Economic stability comes first. Rather than retaliate, Japan is opting for restraint, proving that in the fast lanes of global finance, smooth handling sometimes trumps raw acceleration. The ripple effect of these responses now echoes beyond national borders. Let's zoom out to see the full global picture. Wider consequences. When trust in treasuries wavers. As the US Treasury market shakes, so too does the scaffolding of the global financial system. US bonds have long been the gold standard of safe haven assets. But when even those begin to falter, investors everywhere start questioning the reliability of the entire economic engine. America's rising borrowing costs aren't just a domestic headache, they're a global migraine. If major debt holders like China or Japan begin rebalancing even modestly, the ripple could turn tsunami, reshaping capital flows, destabilizing currencies, and nudging central banks worldwide toward reactionary moves. And let's not forget the lesson under the hood. No economy is truly isolated. In today's interconnected world, trade policies in Washington can torque exchange rates in Tokyo, tweak interest rates in Frankfurt, and alter investment sentiment in Sao Paulo. So where does all this lead? Final verdict: debt diplomacy cuts both ways. The recent shockwaves in the US Treasury market aren't just a blip. They're a warning light flashing on the global economic dash. Trump's tariff blitz may have been aimed at restoring leverage, but it ended up shaking trust in America's financial engine. With China and Japan collectively holding over $1.8 trillion in US debt, the threat of a sell-off looms large. But it's a risky move for both sides. This isn't straightforward economic warfare. It's more like a standoff with both parties tied to the same vehicle. One wrong move, and everyone crashes. Do you think China or Japan would actually dump US treasuries? Is this a real threat to the US economy, or just financial posturing? And how could all this impact auto prices, interest rates, or the future of EVs? Let us know what's firing up your thoughts in the comments below. And don't forget, subscribe to Piston Pundit, your ultimate pit stop for vehicle updates and global auto insights. Thanks for riding with us. We'll see you on the next stretch. You can now check out any of the videos on the screen. There's plenty more to explore.